G'day viewers, I'm Adam Stokes. Welcome back onto the channel for an all-time high day. Things are looking very good, but of course, with your crypto profits comes the responsibility of taxes on your crypto. So I've brought back to the channel Eamon from the Crypto Tax Calculator. How are you, my friend? Happy all-time high day.
Happy all-time high day. Doing great. Thanks for having us on.
My friend, I've been very impressed with your product. It's helped me, it's helped my clients, it's helped my crypto family. Let's go back to the basics. Do you have to pay tax on crypto profits?
Of course, the basics are important. So first of all, none of this will be tax advice or financial advice. So please seek good information from a qualified accountant and tax lawyer. But essentially, yes, in Australia, there definitely are very strict tax rules as to what is taxable and what isn't taxable with crypto. Unfortunately, the vast majority of transactions are definitely taxable. You definitely have to report that to the ATO.
Now, we should also emphasize that, of course, we're going to talk about what's happening in Australia with the ATO, but your product is global. And where it gets confusing for many viewers out there is, in the first instance, many years ago, people would say to me, Adam, you're wrong. You don't have to pay tax on crypto. Well, of course, you can see I've had the Australian Taxation Office Commissioner on this channel. I've referred to ATO laws. We can see that the world is looking for places to go to where they don't have to pay tax on their crypto gains, but noting most people around the world are living in non-tax-free jurisdictions, they do have to pay tax on their crypto gains. So although we're focusing on Australia, we should actually say that your product works globally. Is that correct?
Correct. We support more than, I think it's 50 countries at this stage. So definitely supports all the major tax jurisdictions you could imagine. Yes. US, Australia, Canada, New Zealand. Yeah.
And then the next part we have to consider is that where it gets confusing with crypto taxes is it's not just about buy low, sell high, or the other way around, which many people sometimes do, buy high, sell low, not the way to do it, kids. But you're also paying tax on, again, noting this is not taxation advice or financial advice, you have to pay tax on airdrops, yield farming, when you're sending, receiving, and consequently when we're operating with different coins at different dates, different exchange rates on different platforms, crypto accounting becomes an absolute nightmare. And you can see the Australian Taxation Office has recently sent out many letters to everyone who's been in the crypto land saying, hey, we can see that you're using crypto. Make sure you do your crypto taxes. So why would I not want to spend a Saturday night doing line by line accounting of a year's worth of crypto trading and airdrops and forks and yields and so forth? Why would I use you over just doing line by line accounting myself?
Well, if you do have a handful of transactions, you probably could do this yourself and you may as well give it a shot. But at the same time, I personally wouldn't want to mess around with the ATO. I want to make sure that I do my transactions and my taxes correctly. But essentially, it's easiest to think about what transactions are non-taxable. So when you think about what's non-taxable, essentially it tends to be any transfers between wallets that you own or exchanges that you own. So if you're sending money from CoinJar to your MetaMask account, or maybe like from your Phantom to Coinbase or any other transfers, generally that's seen as non-taxable. But the vast majority of other transactions are taxable. So just like you said, if you're adding liquidity, maybe you put in one ETH and like 1,000 USDC, you withdraw liquidity a month later, and now you're getting, instead of one ETH and 1,000 USDC, you get maybe 1.2 ETH and 800 USDC plus rewards. So you got to think about, okay, well, what's the cost base of all these two different assets? You got to keep that into account because it's not as simple, of course. Like impermanent loss is a thing. You have to account for permanent loss. And then when you claim the rewards, you have to consider the market value of those rewards at the time that you claim them. And for example, for airdrops, there's different tax laws, whether it's like the first allocation or second or following allocations of airdrops. For example, there were some tokens that were released on multiple different dates. There's different tax laws for that. There's just a lot to handle. NFTs, if you have like bulk mints, you have to consider gas fees on every single transaction. So of course, that's like another calculation to run. So if you're good in Excel, you can probably do this over some days, if not weeks. But I definitely would rather automate this where I can, for sure.
The thing there is that, let's say you can do it yourself over days or weeks. As you may realize, you can't say to the ATO, hey, I'm worth $50 an hour and I did 20 hours on my taxes, so I'm paying myself $50 an hour. Therefore, I want to claim that as a tax deduction. What I've found that, again, we can't say this is financial or tax advice because legally we're not allowed to, but we can say to all other viewers out there, go and follow up what I'm about to say with your tax accountant, is that this becomes a legitimate accounting expense. Therefore, I can claim it on tax itself. That is, using the crypto tax calculator does not cost anything to use. What you're paying for is the tax report. Can you just go over what are these tax reports that we're buying? What are the differences in the options that you have? And what are the costs?
Absolutely. So we have a variety of different tax reports, and it depends. The majority of users will just need our MyGov report if you're an Australian user. So that includes all the fields, like all the, let's say, the different numbers that you're required to fill out your MyGov report. So long-term capital gains, short-term capital gains, your losses, your ordinary income. If you had any like derivative trading income, that's separate. There's also any expenses. So they are the different fields that we provide. Then we have like let's say you can drill into particular reports. So we have a capital gains report that only goes through your capital gain transactions, an income report if you want to go through all your income transactions. We have about 10 different types of reports. So if you really want to drill into the transactions and your accountant really wants to see everything line by line, we have a transactions report. We have a report for everything. Same if you're even like a trading stock trader, that we also do have a specialized report just for that, which is a very niche use case just for some Australian users. Even like we export into different softwares. So we have every report you can imagine. And unlike some competitors, when you pay to access our software, you pay for 12-month access to the reports. So it doesn't matter if you download 1 report, 10 report, 100 reports, doesn't matter. It all costs the same price. So you just have access to your reports for 12 months. And you can also go back historically. So if you want to do last year's taxes as well, if you're doing it late, or if you just want to check up on last year's reports, you can do that as well. You don't have to pay anything extra for that.
And does the price change depending on what tax jurisdiction you're in? So if I'm in Australia or America or Canada or England, is it the same price?
The price does slightly differ. We do have some local pricing, but I can run you through what it looks like in Australia, since that is the majority of the users here. So it starts at $49. I do have a special coupon applied. So yeah, it starts at $49, and it's based on the number of transactions that you have across all financial years. So it can be between $49 and $400, essentially.
So what you were saying just then is that you can generate multiple reports. So I didn't realize that. So I can generate a report right now, pay for it. But then if I want to generate another one within the next 12 months, I've already paid for it for a 12-month period. I can get that report again.
Correct. So for example, today's July 14. You can pay today, download the report today, and then next year, if you're quickly onto it, you could do your reports for next year in like July 12, July 13, and then not have to pay for next year's if you really wanted to. Yeah.
Why did you do that? I mean, thank you, but why did the company do that?
Especially, but we don't want people paying per report because that doesn't exactly make sense. Like you have access to the software. That way you can go back multiple years. So especially there's a lot of people that haven't done the crypto taxes in a few years, and it felt like overcharging if you charge them for like 4 or 5 different tax reports when we already have that data. So I don't know, bit of a company business decision we made a few years ago and stuck with it ever since.
There is a reason why I like working with you. I should point out to everyone I'm not being paid for this interview. I have a good relationship with the Crypto Tax Calculator. If you use the link in the description below, you'll get 35% off your tax report. It's a good deal. It's a win-win-win model. You win, Eamon, because you get a customer. You win, viewer, because you get a 35% discount. And I win because I get a small kickback. It's a model we like using. Now, Bernard has asked a question. He goes, yo, what if you just buy and hold? So he's asking about tax implications. If I just buy some Bitcoin, I don't sell it, do I pay tax on that?
If you only buy and transfer between different wallets you have, like if you transfer it to a cold wallet or a hardware storage device, I can't see any tax implication there. Of course, if there's gas fees involved, which there well likely would be with Bitcoin or any other asset that you're holding, you would have to pay taxes on the gas fee. But that's it, essentially. It's just a gas fee. So you could probably calculate that manually if you really wanted to.
Yeah, so essentially, Bernard, again, not tax advice, but the tax event occurs when you liquidate that product or that crypto, or as Eamon said, if you send it to someone else. So if I send it to my own wallets, there's no tax event. But if I send it to someone else's wallet, there is a tax event. And what's interesting is what's good about the Crypto Tax Calculator is that when I'm moving my crypto from myself to myself, as in from my own exchange to cold storage to something else, if it's all my wallets, the Crypto Tax Calculator can calculate that or see that and say, well, then, even though this crypto has moved, and when it moved, there was a price difference from the time he bought it, from the time that he moved it, because he's moving it to himself, there's no tax event. True or false?
That is correct.
Okay, the next thing is that what's very interesting is when you're using the Crypto Tax Calculator, it should be pointed out that it's not just about looking at transactions, and you touched on this before, but looking at transactions that incur a tax event where you're going to pay the taxman money, correct me if I'm wrong, but it also calculates, as you mentioned, gas fees. That's an expense to you. So that's something that you can offset your profits. And equally, when you sell at a loss, it offsets your profits also. So it's not just about calculating how much you owe the taxman, it's equally calculating how much you don't owe the taxman.
Correct, absolutely. And we also, on top of that, we aim to identify any savings opportunities that you may have, both looking back and going forwards. So, for example, we show and say, hey, you might have bought this NFT for $10,000, let's say, and you might still be holding it. And we might suggest saying, it's probably a good idea to sell this NFT because the current market price is much lower. It's been a certain amount of times. And then if you do sell that NFT for a loss, obviously that would offset any gains that you might have in that financial year. So we do things like tax loss harvesting. That's another tool that's available in the software. We also identify any other savings opportunities. So for example, if we see that there are some assets where we're not exactly sure what the market price is, we ensure that that is raised to you to say, hey, we've assumed that it's X market price, but can you please confirm just to double check that we're not overestimating your capital gains? So where possible, we try and minimize your taxes, of course, in the legal way where possible. We even allow different inventory methods, which can have a significant impact on your taxes. Of course, that's a bit more of an advanced technique that would definitely require the oversight of an accountant or a financial tax planner. But for example, you can change from first in, first out, FIFO to LIFO, HIFO, average cost basis, tax effective. We have a variety of different inventory methods. So there's definitely a few ways to calculate your taxes and minimize them in a legal way.
The one that I've been looking at is HIFO as opposed to FIFO or LIFO. The HIFO is actually pretty good, like highest in, first out, and LIFO, lowest in, first out. Now, this may sound a bit complicated to some, but when you were talking about maximizing your tax savings legally and compliantly, and you're talking about that you as the crypto tax calculator can help the viewers or the user do that, like what happens? Does it happen automatically? Is there a human at the other side looking at it? Does the customer have to engage with you and say, hey, can you help me? How does that work?
So we as a software don't provide any tax advice. So that is like the onus is on the user and their accountant and tax planner if they would like to change the different inventory methods. But those options are definitely available. So it's just a little toggle in the report settings. It's like available just here on the right-hand side. And then as you update this, you can see in real time. So by default, it'll be selected as first in, first out. Let's say we want to change it to last in, first out. That'll take a few seconds to recalculate based on how many transactions you have. And then you'll be able to see this transaction change, this total gains change. I think it was 29,000. It's slightly increased, or I guess decreased because it was negative. So you've actually have more tax losses here. So then you could even use this to offset more losses next year. Of course, it's hard to say. Inventory methods are a bit of a rabbit hole in itself. We can't just say one is much more effective for the variety of users. Depends what you're optimizing for. For example, are you optimizing for long-term gains, short-term gains? Because in Australia, they're obviously taxed at a very different rate. Are you optimizing for capital losses? Depends what you're optimizing for. So all the different options are available for you in case you'd like to experiment.
And if anyone's wondering why you would like to maximize capital losses, it's a form of tax harvesting where sometimes you actually want to have a year that loses that can offset a year that wins. So it can get pretty complicated, but if you don't have the data, you can't make these decisions and make these moves. So let's go through plugging in the data. Hang on, I'll go back a step. Some people get nervous when they talk to me and they say, well, hang on a second, why would I give a third party all my personal information like my wallet addresses and my exchange details? Aren't they going to steal my money? Aren't they going to steal my crypto? Your response?
My response is that everything that we have is only read access, and you have the control. You're in control of that. So, for example, when you provide us with, let's say, you want to add in a MetaMask account, you're the one here that just types in your ENS domain. Like, for example, I could just type in amen.eth, and this is available to anybody. You don't need to put in any private keys. Just as we highlight here, we don't have access to your funds. We don't have access to to your funds at all. So don't enter in private keys. That is not what we need. All we need is just your public wallet address, which is already visible in the blockchain. Same with any API details that you might have. For example, for Binance, you can select read-only API. That's the same for every exchange that we've seen so far. So every exchange has a different process, whether you want a read-only API, which means that we can see your history, and a trading API, which allows like trading bots and other software and other solutions, which we don't need access to those permissions. And if you're very cautious, you could also import a CSV, And of course, with the CSV file, we can't do anything. It's just a document that we just read for you. So they are the different options, but essentially we just have access to read access to your information.
And what's also important to know is that the actual portfolio tracker, of all things, I actually find the portfolio tracker is the best part of this, beyond the convenience, of course, of generating a tax report. But what are we talking about with the portfolio tracker? What do we got here?
So because you already have all of your crypto data within the platform, we thought we may as well make a portfolio chart out of it and a portfolio, let's say, tracker. So unlike other portfolio trackers, we can only see, let's say, your on-chain positions, or you can only see your positions on a particular exchange. We already have all your data aggregated across on-chain and off-chain. So we're able to combine that. Just a simple chart, we have your net fiat invested, so you can see are you at an overall loss or at a gain, your asset allocation, and then you can even break it down. What happens sometimes internally in the team is that there might be a wallet that you haven't touched in 2-3 years, and the price suddenly shoots up. And then you might see this in your asset allocation. You're like, why am I holding this particular token? Then you scroll down and you find it in like a really old wallet that you haven't touched in years. Then next thing you know, it's worth like $2,000. That's happened a handful of times across the team. So it's also fun and convenient to find some maybe old coins that have pumped out of nowhere. So definitely a good feature that comes in now and then. But yeah, you can see your winners and losers, your top trades. So it's just a handy portfolio chart.
What's the risk of using your product?
Say again, sir.
What's the risk of using your product?
The risk would be you want to make sure that you make the correct tax assumptions. So there are some times where we don't exactly know what the transaction might be. And we call this because there's off-chain data. That's how we refer to it. So for example, this one here, there's a 26 ETH that is incoming into this particular wallet, and it's coming from an unknown source. In this case, we don't know whether this could be your grandma's wallet address and she's gifting you this ETH. Maybe it's from work and this is an income transaction, or this might be from an exchange that you haven't inputted yet. There is some data that is off-chain, that is not on the blockchain, that we are unable to get, and therefore we rely on you as the user to update this transaction. So the risk is that you might interpret your own transactions incorrectly. That's obviously a risk that could happen. We do have different systems in place to create some warnings and try and minimize that where possible, and obviously give you suggestions and insights where possible. But there always is a possibility that the user themselves misunderstands their transactions. Of course, hopefully it doesn't happen too often, and people recall and understand that, $100,000 transaction, you probably remember that more than most other things.
I've got a question here, and I encourage all the viewers to throw in any questions that you've got, because that's why we're going live, so you can interact with the good people from the Crypto Tax Calculator. Avrax Black says, how are inverse perpetuals taxed, and how is not an unrealized gains, double negative there, how is not an unrealized gains tax when you don't sell the crypto for fiat?
I've heard of inverse perpetuals. What's that referring to?
Avrax, I'm not sure I understand your question. How are inverse perpetuals taxed? That's tax advice, so we're not going to give you tax advice. And then you say, how is it not an unrealized gains tax when you don't convert?
Oh, I see what you mean. I believe that what they're referring to is saying, why aren't you just taxed when you sell crypto? Which is a very common, I'd say the most common tax position that we see amongst our users, is that they assume that any crypto to crypto transactions are non-taxable because you're in the crypto hemisphere, you're in the crypto space. If you're shopping ETH for DAI, then DAI for USDC, and then USDC for some like Hyperliquid or some other token, you would think, well, these transactions aren't taxable until I off-ramp this money back into my bank, or I sell this for a fiat, for AUD, USD, whatever your fiat currency is. Unfortunately, that's not how the ATO sees this, and it's not how most tax jurisdictions see this. I don't want to say most, but there are many tax jurisdictions where crypto transactions are taxable. Of course, it depends on the jurisdiction, but definitely in Australia, it's definitely seen as taxable. So unfortunately, we don't make the rules. We just follow what the ATO says. Of course, if you would like to amend those rules, you can go into our settings. We do have tax settings, and you are able to manually change everything. So if your perspective, with guidance from a tax accountant and from a tax lawyer, says that, hey, crypto to crypto transactions are non-taxable, you're able to amend that. So we just provide the default settings based off our tax lawyers and based off our tax knowledge, but you're always able to amend every setting that we have. So airdrops being income, crypto to crypto trades being taxable, liquidity deposits, collateral deposits, every category you're able to customize that as you wish. So we give you the defaults, but if you would like to change that, absolutely you can do that.
Yeah, it's a good point and a good question. It's frustrating for all of us. So yes, if you swap one crypto for another, that is a taxable event. If you swap your Bitcoin for Ethereum, even your stable coins for another coin, or go from what your coin into a stable coin, the misconception by many is like, oh, I'm still staying in the crypto space, so I haven't made any gains. That's not the law. The law is, as Eamon just explained, when you swap from one crypto to another, that's a tax event. When you get staking rewards, that's a tax event. When you send your grandma some crypto, that's a tax event. And the crypto tax calculator can pick all of that up. And it's very frustrating for all of us because, as Eamon said, we don't write the tax laws. We just comply with the law, as frustrating as that may be. And many people get really wrecked in this. I'll just give this to the viewers. Many people think that like when you sacrificed for a project, that is, you gave up your crypto to invest in some type of project, or you gave away your money for an ICO, IEO, IPO, that there's not a tax event. There is absolutely a tax event. The tax event is the price. Let's say you do Ethereum as an example. You bought Ethereum at $1,000 and then you sacrificed it when Ethereum was $2,000. Even though you no longer have that Ethereum and you think you've sacrificed it or given it to an IPO or an ICO or IEO, it doesn't matter. There's a price difference from the time that you bought it at $1,000 and then the time that you disposed of it, swapped it, sold it, sent it, sacrificed it, whatever verb you want to use. The delta between the day that you bought it and the day that you disposed of it, sold it, sacrificed it, sent it, or whatever, that delta is what you're taxed on. It's a tax gain. Now, we, of course, you could go the other way. If you bought it at $2,000 and then sacrificed it, sent it, sold it, or whatever at $1,000, you've actually done so at a loss, which then goes to the next part of this. Of course, as you know, Eamon, if you've held the asset for more than 12 months, you only pay tax on half the profits. If you held the asset for less than 12 months, you pay tax on all of the profits. The crypto tax calculator can calculate this?
Absolutely. So we do account for short-term and long-term gains in Australia. Also in other jurisdictions, they do have certain, let's say, features of their tax law that are also unique. So we do also support those. For example, the UK has like their own, let's say, cost basis and inventory method called the HMRC method. So we definitely do account for these localization tax impacts. Yes.
Got another question here from Riddler. He says, I'm using CTC. How can we ensure there are no duplications of transactions? Is there a way to check?
That's a good question. Generally, we do have a very good deduplication algorithm to ensure that no transaction is brought in twice. There's very rare scenarios where, and we do show warnings before you go through that process, where it is possible to actually have transactions brought in twice. But essentially, what we do is we ensure that whenever you sync your wallet, we only pull in transactions from when you last synced. So there shouldn't be any duplicates, but if you did want to go through, probably going through line by line might be the best option. But beyond that, I would say pretty confidently that our deduplication algorithm is quite strong. So I wouldn't be too concerned about that.
Can you show us just basically a quick guide of, so someone uses the link below, they join the crypto tax calculator. What's the first thing they're doing? And can you explain perhaps the difference, whilst you're doing this, the difference between inputting data with an API, a public address, and a CSV file?
Of course. So when you sign up for Crypto Tax Calculator, it's essentially a three-step process. First, to know and to be able to calculate your taxes, we actually need to have your data within the app. So first you need to import your data, and they'll go through this, let's say, a bit more step-by-step. Then you have to review your own transactions just to make sure that this is all as you expect. And then you download your tax reports. That's a three-step process. So with regards to the import process, let's say that we've detected here, which is a new feature actually that we've released recently, we've detected that you have a CoinJar transactions. And this is because we're able to see that in this case, that you sent XRP to an address that is labeled as CoinJar within our system. And therefore we know that, hey, you likely interact with CoinJar. So let's say that I want to add a CoinJar account. There are two different options here. CoinJar is a little bit special because they have their own OAuth option, kind of like Google OAuth. You can connect with CoinJar. And the other way is through CSV. So I might give another example just to highlight this a little bit more. So when you sync by API, essentially what that means is that right now you go to Coinbase, you create an API key, you set up the right restrictions, so only give us read access because of course that's all we need. We don't need trading access. So once you give us read access, you paste in those API keys, You paste them once, and that's it forever. So let's say that next year you come back to CTC, you log back in, you want to do your taxes again. All you do is you just press the green sync button, give us a couple minutes, and we'll import your Coinbase transactions easily. The other option is to upload via CSV file. Now, of course, this is just a one-off document that just goes through all of your transactions from this particular exchange. However, next year, if you want to import your data, you just have to do this process again. So you have to go back into Coinbase, you have to find your transaction history, you have to download the right CSV file. Sometimes there's multiple CSV files, and you have to upload it into CTC. It's just a bit more of a process. There's pros and cons to each. I'd say the vast majority of people internally and that users that we talk to do use API for the convenience. And then some exchanges, we also support connect with this particular exchange. But API and CSV are by far the most common, and they're the main differences over there.
What works best for the crypto tax calculator? The public address or an API? Because I noticed, as an example, with COINSPOT, I plug in the API and it's seamless. It's beautiful. It just synchronizes so easily. But then with some of my other wallets, I've got to put in my public address, and that sometimes doesn't seem to sync. What should the viewers be more leaning towards? API, CSV files, or public addresses?
So public addresses are how you should be importing, let's say, any on-chain transactions. So for example, if I want to import a Ethereum wallet, let's say, I click on Ethereum, the vast majority of users, which I would strongly recommend, is you just paste in your wallet address. So you just copy it from your MetaMask, paste it in. It'll start with 0x, or you can put your INS domain, or if you have like subdomains, base names, all of that, we support all of those. Feel free to type those in as well. You are also able to upload via CSV, but considering the data is already publicly available in the blockchain, there's not really much benefit to uploading via CSV. So if it's a on-chain wallet and you do have a public wallet address, you can just paste that in. Same with Cardano, for example. We support like the different, let's say, wallet address formats. Sorry, some start with a address one, some start with stake one. You paste that in, and then we'll automatically import that for you. Now, for an exchange, there is no public wallet address, so it's either CSV or API. So they're the two options. If an exchange is either CSV or API, and if it's a wallet, it's just a public wallet address.
And we should point out API is Application Program Interface. Is that what it stands for? I think
that is what it stands for, yes.
Oh, I can't believe I remember that off the top of my head. And if people don't know what that means, it's basically getting one program to talk to another program, a way of connecting, for example, COINSPOT to CTC, and then they can speak with each other and synchronize with each other. But again, it doesn't allow Crypto Tax Calculator to take your money away from COINSPOT because it is read only. I've got another question here from Avrax. I'm not sure I'll understand it, so I understand it. So I'll have a go, then you have a go, Eamon. It says, you start with BTC, you finish with more Bitcoin. How is that another crypto? So Bitcoin, BTC is the ticker for Bitcoin. That's not more Bitcoin. So if you start with Bitcoin and finish with more Bitcoin, I would suggest that's because you've bought more Bitcoin. But if you mean that you went from Bitcoin and you traded it around the crypto land, and you went from Bitcoin to Ethereum into a Tether, a stable coin, and then you went into, I don't know, Cardano, and then Tron, and then back to Bitcoin, each one of those events is a taxable event. But when you say you start with BTC, you finish with more BTC, how is that another crypto? Bitcoin is Bitcoin, and BTC is the ticker for Bitcoin, so BTC is not another crypto. You then said, it seems to be arbitrary unrealized tax because when you pay the tax, the price could drop 50% the next day. So that the tax is calculated the day that you sell the crypto, or buy the crypto, or swap the crypto, or receive the crypto. Now, if it changes the next day, that's irrelevant because the calculation date is the date that you buy, sell, swap, receive, fork, or whatever happens to the crypto. Eamon, you want to have a go at that?
Yeah, I can touch on this. Particularly I think you touched well on the first point, is that just like, let's say stocks, if you start with like, I don't know, Robinhood, and then you trade around a few different assets and then you end up with Robinhood again, doesn't particularly matter what you started and finished on. The fact that you dispose of Robinhood in the first place, and then maybe you bought Tesla, and then you bought something else. The fact that you dispose of these assets in the middle, that's really what the ATO cares about, that you acquired an asset and disposed of an asset. Doesn't matter if you like started and finished with the same thing. Now, it's different if you are trading as a business and like you're I forgot the technical terminology is a bit outside of my tax league, but essentially is that if you are a trader as like a business, like you do this day to day, like you have a tax plan, you maybe have like a trading investment firm, then it's different. Then what some trading firms do is that they just look at what you have at the beginning of the year, what you have at the end of the year. You just see the differences. Happy days. That's just because you might have millions of transactions, even like tens of millions of transactions. So calculating gains line by line isn't feasible. That's a very niche scenario that should only happen if you're trading as your primary source of income. Of course, check that with a tax lawyer and tax accountant. So there are scenarios where that is the case, but for the most users, anytime you sell Bitcoin, even if you come back to Bitcoin at the end of the year, that's still taxable. But back to the other point, there definitely have been scenarios, unfortunately, where we've had a few users. Of course, we couldn't do anything about it, but we just hear this through our support channels, let's say, where you might receive an airdrop that's worth $50,000, or maybe let's say $100,000, a huge airdrop, and you receive it end of June. So that was classified as income, let's say in this scenario. So you have to pay income tax on that $100,000, which could be 30, 50 grand, even higher, depends on your tax bracket. Now, let's say that a week later, that airdrop goes to zero and you sell it. Now, you do have a capital loss incurred. However, you still need to pay your income tax on that $100,000 of income. And a lot of times people don't have this money because they sold it for zero. And sure, in the next financial year, they've got a $100,000 loss. But in the last financial year, they've got this $100,000 of income that they have to pay taxes on. So they can, obviously, that's one scenario. If you compound this has happened multiple times, especially when the bull market kind of stopped right before the tax season finished. So we have had a few users who have run into this scenario. So it's definitely not a pretty one. I'm not sure exactly how that works out. I think that there might be that's definitely a time where you need to talk to an accountant to see if there's some flexibility with when you pay your taxes, how you pay your taxes, you do it in installments. I know there can be some flexibility there. So definitely worth talking to a tax advisor if that's the scenario that you're in.
You've articulated that perfectly. And the same thing happens, I remind everyone, with yields or staking rewards. So I'll give an example. So I was earning a lot of money. Well, hang on. A lot of coins every day when I was staking my ADA. And I had to pay tax on the value of the ADA the day that I received it. It was airdropped to me, or it was yield to me from staking. It wasn't an airdrop, it was staking rewards. But I didn't sell the ADA. So at the end of the financial year, the taxman goes, well, you received $50,000 worth of ADA staking rewards. And I'm like, yeah, but I haven't sold it. And they're like, we don't care. You owe us tax on $50,000 worth of staking rewards. Now, if I didn't sell it, if I sold it that year, then great, I've got $50,000 and I've got to give half to the taxman to keep the number simple. But if I didn't sell those ADA staking rewards, in that tax period, I still have to give the taxman $25,000 to keep the number simple, $25,000 worth of fiat on $50,000 worth of crypto that I have not liquidated. And I emphasize to everyone, this isn't my fault. This isn't Eamon's fault. This is the ATO's fault. And we have to comply with those laws. And if it gets frustrating, that's why many people leave and say, well, hang on a second. You want me to pay tax on unrealized gains? Because it is an unrealized gains because you haven't liquidated it. I say, when I spoke to the ATO, I said, look, I reckon that would be fine if you accepted ADA. And they're like, no, we don't accept ADA. We only accept the dollar. And it's like, okay, so let me get this straight. I get an airdrop or a yield or some type of crypto that's dropped to me. I didn't sell it. I've got no money because I haven't done anything with it. But now I've got to come up with $25,000 in your money to give to you because I received crypto in their money that I haven't even received in your money. And it's like, yes. Now, again, as you described, Eamon, if the price drops to zero and I sell it that year, or the next year, I should say, it's a loss that I can carry forward to the next year. But for the year that I've got it airdrop to me, I have to give the ATO money. And some of my clients have been wrecked by this. And it sounds like you've gone through it yourself. And people get really angry and upset at us. And it's like, hey man, you think I want to pay tax on this stuff? I just comply with the law. This is the laws of the land. And we see this everywhere where airdrops come to you, forks come to you, staking rewards come to you, and you have to pay fiat dollars on a crypto profit that you have not liquidated and you actually haven't taken anything from. It's very frustrating, but it's the law. Nick, anything you want to add to that before I go to the next question?
No, that's bang on. It's an unfortunate situation, has happened, especially when Terra Luna collapsed, obviously. A lot of people were receiving a lot of yield through Anchor. Then suddenly they had no money to pay taxes. That was not a pretty time. in the ATO or our business. Yeah.
ATO, they're always going to win. Nicholas Barone says, looking to start receiving BTC as a payment for my business. What are some things I need to have for tax time? Looking at part payment, BTC and Australian dollars. We may just be going into tax advice there, but is there anything you want to say? Or?
I don't have anything on that. That's more definitely needs some assistance from a tax accountant or a tax lawyer there. I mean, you can use our software if you want to do some bookkeeping, but if it's simple BTC payments, it honestly might be easier in another software. Since if the majority of your transactions are in fiat and you just have some Bitcoin, it might be easier to just use a TradFi solution. But we do have a normal business solution as well for crypto if you do a lot of heavy crypto transactions. So yeah, look for a tax advisor.
Blade says, guys, I'm new to crypto. I just bought Nano S, plus I plan to hold for 5 years, a bit of ETH and Sol. I just found a lot of people are saying I should change wallet. Are they right? Should he change wallet? Hell, we'll give you the tax implications. If you're sending your own crypto to yourself, as long as you can identify it's your own wallet, there's no tax event because you're giving it like from your left pocket to your right pocket. But I think what you're saying is that you should get rid of your Nano S. Probably not completely in line with what we're talking about today, but do you want to touch on it? Anything you want to add?
I don't have any preference of crypto wallets, but no, what you said tax implication wise, that's correct. It's non-taxable. Just you need to consider the gas fees. That's all.
Clary Bonagolt says, I tried to open a Phantom browser wallet last year and had the wallet emptied because I put in the wallet key. What happens with the stolen crypto?
It's a very interesting tax scenario. One that definitely there isn't a straight, clear-cut answer because how do you prove that your crypto was stolen? That in itself is a very hard and tricky, challenging part. So definitely seek help of a tax advisor. They might not even have to be crypto specialized in this scenario because stealing of funds is something that happens also like in TradFi, not just in crypto. We do have a few blogs that I would probably read up on our website that goes into this. That's like written up by our tax lawyer. So that would go into much more depth. But of course, it is possible in some scenarios that you could claim this as an expense, like as a loss, let's say, because let's say you had $100,000, you don't have the $100,000 anymore, so you can't pay tax on that $100,000. But that definitely depends on your scenario. So sorry to hear that happened to you in the first place, but definitely seek some advice to see if you can claim that as a deduction.
Bernard is asking, do you need KYC for your product?
All we need is an email address. And honestly, if you want to just use a spam email address, that's fine. Just put like test123@gmail.com. Obviously, that's probably taken, but use another one. We just need it for Stripe. Like our payment process requires us to send a receipt to somebody. So if you want a receipt to make a tax deductible, obviously try and make it an email address that you have access to. But we don't need your name. We don't need your ID. We don't need your address. We don't need anything else like that. So just an email address. That's all.
Yeah, it's a good question, Bernard, and it's actually a good service that you've got there. So, you know, your financial records are very private, and many people are worried about, you know, if you know, you're sitting on $50 million worth of crypto and I've sent you my name and address to you, and then suddenly I've got guys kicking open my door. I'm glad you asked that, Bernard. You know, you don't need KYC for this. And as Eamon said, you just need an email, and the email could be anything for that Stripe purpose. I'm glad you raised that. Avrak says, appreciate the quick response, fellas. An inverse perpetual contract is a crypto derivative that is dominated and settled in the underlying crypto, BTC, for instance. Excellent. Look, we're coming up to the half-hour mark. Riddler has said, on CTC, can we separate personal accounting and accounting for business? Good question.
Good question. How it works in CTC is because they're two different tax entities, they are completely separate accounts in our software because, of course, they're just separate for tax purposes. So one might be a business account, like in your case, one might be a personal account, might be an SMSF, one might be an enterprise account. So there would be separate accounts. So you would have different logins for those.
So essentially, just on that, you basically run two accounts, like just as you would an email account for your business and an email account for yourself. You'd be running a CTC account for yourself and a CTC account for your business.
Correct.
Yeah, makes perfect sense. All right, look, it's pretty straightforward. Your product is easy to use, and I love using it. I love plugging it because I believe in it and I need it, and I like you guys. Is there anything else you want to go over before I let you go? Anything with the product, with any discounts. Well, hang on, I can get to the discount. If you use my affiliate link, you'll get 35% off, which is a great deal. But anything else you want to cover before we let you go on this all-time high day, my crypto brother?
No, very exciting about this all-time high day. But the main things is that we still keep improving year after year. It's not like we stopped building the product 3 years ago. So if there's new exchanges, new integrations that have used in the last 12 months, make sure to import those. And we have done our best, and I think we've done more actually than we probably had to. So we've spent a lot of time to make sure that we are as up to date as possible, putting all the new protocols, supporting all the new blockchains integrations, improving our automation. So year after year, we're getting better. So if you use us last year, expect this year to be an even more automated process. So hopefully this keeps going to next year as well.
Just one quick question from Bernard. He said, what's it called? It's a crypto tax calculator as per the title. And I've put a link in for everyone there. Just click on that link and the 35% will be allocated to you automatically. You can also put in the code AdamCTC35 for the 35% off. There was another quick question here. Jeanette says, can we define the financial year in the CTC process?
Absolutely. So we'll default to the Australian financial year, July to June. You can obviously change that. So if you want monthly reports, maybe you want calendar year reports, you can definitely do that. So you can amend that as you want, even a weekly reports, you can change that. That's customizable for sure.
And we've also got Grace saying thank you, P. Schmiel saying thank you. I think people were pretty happy with this. How could they not love someone who makes tax something so horrible? Just a little bit more pleasant. I point out again to everyone, I have not been paid for this interview. My only affiliation with the company is a link that will allow you, the viewer, to get a 35% discount. It'll allow CTC to get a new customer, and it will allow me to get a small kickback. That open and transparent here, just as we are with the blockchain. That's the business model that we have here. I have previously used other crypto accounting software, which I no longer use and I do not endorse, but I absolutely support the crypto tax calculator, which is why you can find it on the crypto.land, my company, where everything is safe, simple on one secure site. Eamon, last words to you, my crypto brother.
Happy all-time high day, and thanks for having me on.
Thank you. See you next time.
See you around.